Hey guys, and welcome to episode 3 of the Trader's Apprentice blog, my trading plan. First, a disclaimer. This plan is mine. It's been assembled for myself based on my level of experience and my financial situation. Now, whilst I'm happy for you to use it as a template, I strongly encourage that you create your own based on your own levels of experience and your own financial situation. Why have a trading plan? I'm going to ask you 3 questions and I need you to think about the answers honestly. Can you get rid of your emotions? No, you can't. Can you get rid of your fear and greed? Also no. And can you stop being human? Of course not. So, why have a trading plan? Well, it's about you. It's about how you react and behave in most situations. Being aware of what can affect you and how it will affect you is a preparation tool. It will help you make an effective trading plan that is relevant for your reactions and how fear and greed manifest themselves in your life. This is why it is so important for you to use a trading plan when it comes to entering and exiting trades. If you can reduce the number of random impulses, you help yourself step away from the potential of having your speculation turn into a type of gambling addiction. Ask any successful trader how they became successful, and you will consistently hear that they had a trading plan. This plan guided them when they were making profits and, more importantly, when they were losing money. Not operating with a trading plan is like going on a road trip without a map. A proper trading plan assesses your risk tolerance and your profit goals. It is also the best tool to help you navigate between the demons of fear and greed. Unfortunately, too many traders confuse technical analysis systems with the trading plan. This is completely incorrect. You have to incorporate money management, technical analysis, and risk management together in order to make a proper trading plan. In the words of Thomas Bukowski, our good friend, if you do not have a trading plan, make sure you have a lot of children to look after you when you get older. So Driss trading plan, or my trading plan. I can't express how important it really is for you guys to sit down and think about and write out your trading plan. Now, it has taken me 5 to 6 months to sit down and actually do this. And now that I have done it, I can see the shining light. It will help you avoid the many mistakes that you potentially have made or could make with your trading. So let's get into it. I start off by nominating my goals. My short-term goal is to trade to accumulate $10,000 US to open a Bitfinex trading account. The Bitfinex platform is a more professional trading exchange which has far superior order entry and exit tools. My longer term goal is to trade to a point where my income from trading alone can sustain our family. And at this point, I will look to leave the 9-to-5 grind and trade full time. Now, to do this, you need a strategy. So my next part of the plan is my strategies. My first strategy is to trade identifiable fractals or chart patterns which provide an edge. My second strategy is to trade trend following strategies which also provide an edge. Now, to top this off, for the foreseeable future, until market cap grows significantly or institutional money comes on board, I am going to try my best to limit my trading to the top 100 market cap coins only, and this is due to higher liquidity. As mentioned in my previous videos, this will help you with your entries, your exits, and your stop losses in terms of slippage and other field problems that may occur. Now, risk, which is probably one of the single most important parts of your trading plan. Firstly, you must always predefine your risk. Now, this is how I operate, and you can each choose your own philosophy, but I will risk 1% of my portfolio on each trade. Now, this is not a trade amount of 1%, but a risk amount of 1%. Now, as my portfolio grows, or God help, falls, the 1% amount will increase or decrease proportionally, hopefully increase. So how do we define the 1% risk? Firstly, I'd like to touch on risk reward and risk reward ratio, as I've had a number of questions on understanding this. Now, over on the right hand side of the screen here, I have the long tool, and obviously the short tool is the opposite. We use this for our trade setups. What this tool produces for you is based on your entry position, which is the grey line through the middle, where you nominate on the chart, and it will have a price point for you. You nominate a stop loss position, which will give you a stop loss percentage. Then you will nominate a potential target or potential gain position, which you are aiming for in your trading. In this case, it is set at 16.16%. Okay, now what that means in terms of risk reward is you are going to risk 5% of this trade capital to potentially gain 16% profit. So your risk reward ratio is simply the 16.16 divided by 5%, which is 3.23%. So in layman terms, you are risking 5% to potentially gain 16%, and that's simply how the risk reward works. But I'm talking about something else, something different here. I'm talking about how you're allocating your portion size to each trade. Now, I want to risk 1% of my portfolio. So let's say that I have a $10,000 portfolio. So risking 1% will be $100. You do not trade $100 as a total trade amount. You are risking $100 or your 1%. So how do you calculate the total trade amount? The trade amount is the dollars of risk, or your $100, divided by your stop loss percentage in percentage terms. So the 5 divided by 100. So in this case, we have $100 divided by 0.05, which equals $2,000. So a trade risking 1% of your portfolio with a 5% trade risk or stop loss means a total trade amount of $2,000. Again, if I put a $2,000 trade on this setup here on the right and I am stopped out, I will lose $100 or 1% of my portfolio. I hope this is clear. If not, please hit me up in Discord and I can explain it a little bit further. So we've defined our risk. Next, we need to define our trade mechanics. Now, I will set clear entry, stop loss, and targets prior to entering any trade. That way, I will always know where my targets are, where my stop loss is, and how I'm going to manage the trade without causing myself to think something else may or may not happen. You want to remove thinking from your trading and trade mechanically. Now I'm going to touch on something that may be a little bit confusing. When we do our trade setups, we have an entry figure, we have a stop loss figure, and we have 1 to 2 target figures, which are based on chart patterns, measured moves, or other potential support resistance positions. Okay, I do something a little bit different, and I've learned this from my trading psychology work. And the reason I do this is to enter a risk-free situation in a trade, and therefore a non-emotional state of mind. Now let me explain what I do. We've talked about risk reward, okay? And you can allocate that risk reward, as we did previously here, 16 to 5, okay? What I do is I scale out half of my total trade amount at a risk reward of 1 to 1, which I designate as my target 1A. Now, this is an important psychology trading procedure, which means that when my trade gets to the 1 to 1, so if your stop loss is at 5%, your 1 to 1 is a profit of 5%, I take 50% of my trade. What that means is that your risk percent of 5, which would have lost you $100, turns into a profit of $100. And if you take out your 50% position at that point, you enter in a position where if you are then stopped out, you have a net zero position on your trade. And when you operate in a situation where the worst that can happen for you is a net zero position, it does wonders for your mindset. Now, I can show you the mechanics of how that works in mathematics in a different video, because I want to touch on that a little bit further in the future. So once I've done that, once I've taken my 50% out of the trade, I then let the remainder run to either the predefined targets based on the chart pattern measured moves, designated as target 1 or 2, or manually move stop losses. Okay, so why do we manually move our stop losses? Now, as we know, we don't always reach target 1 or target 2. Sometimes the market, or if Bitcoin's having its moment, can make our positions move against us. Now, going back on that scaling out at 50%, the reason, I guess, the psychology behind that is that many times when you enter a trade, the trade doesn't automatically just straight away crash out on you and tank. What happens more often than not is the trade will start in the direction you want it to move. It'll get a little bit of the way towards your target and then turn around and then move against you. So this 1-to-1 risk-reward ratio and scaling out will put you, as I said, in a net zero situation. So if you are stopped out, you have not made a loss. And again, that state of mind that you operate in when you're in that situation really frees you up to avoid many trading errors. Okay, so back to moving your stop losses. Now, we have our measured moves and our targets. As I said, we don't always get them. So we manually move our stop loss, and we don't generally use a trailing stop loss because they will always be hunted by the market operators and the whales. But what we do is, based on our entry time chart or our next higher time frame, we will move our stop loss to a position that is underneath the next higher low in the trend. Now, only if there is a very strong daily trend or significantly positive market sentiment that I may not scale out at 1-to-1. But at the moment, in the current market, that would be less than 5% of my trading or trades. So how do we do that? Now, again, just for this example, please bear with me and let's assume that that is a nice ascending triangle, okay? Let's just say our entry is somewhere along the bottom of that triangle, and we had a nice touch point and a perfect entry as Mitch can tend to nail it on the spot for us. We set our stop loss below the previous low, and off we go. We're in our trade. Now, as the trade trends up and then comes down and hits the next higher low, we wait for it to then take off again in the direction of the trend. We have already scaled out at our 1-to-1, which would be the same percentage in profit that our stop loss was. So we're in a nice risk-free situation. We let the rest of our 50% of our trade run. Now, once we've started heading off from our next higher low, we move our stop loss from its original position to position 1. Okay, the trend continues, and trends are cyclic in nature. They will go up, they will retrace, they will go up, they will retrace. So on the time frame that we've chosen, we wait for that second or that next retracement, and that's going to take time. Remember, we're swing traders, so these are all 4-hour candles, so you must be patient. You're already in a risk-free situation, so it comes back down here, creates the next higher low, and starts moving off in the direction of the trend again. At that point, we move our stop loss from position 1 to 2, and we continue to move underneath each next higher low as the trend continues, at which point we will either reach our predefined measured move or our target based on our chart pattern, or Bitcoin will do something crazy, or the market will move against us and stop us out. Either way, we're going to be stopped out in profit and be happy. Okay, so once you have your goals set, once you've defined your risk and you've got your strategies and you understand your mechanics of the trade or trading, you set yourself up some rules. Now, my rules, and this is for my trading, and you can do what you choose to do, but for the time being, in the current market conditions, I have set these rules. You can always modify and change your trading plan at any point or any time as the cyclic nature of the markets move. But for right now, this is how I'm trading. My first rule is that I'm going to trade with the trend, preferably or minimally seeing a nice daily trend, okay, which is a concession of higher highs and higher lows. Now, that doesn't mean I'm not going to trade chart patterns. That simply means I'm going to be very conservative and selective with my chart patterns. I'm going to prefer at the moment to be trading ascending triangles, which will have a succession of higher lows. I'm going to be looking for bull pole, bull flag situations. Again, you're looking at higher lows. Or when it comes to the wedges that are currently presenting themselves in the market, safely and conservatively, I'm going to wait for the break of the top trend line and the hook back down to retest that trend line. Why? Because that will then present an entry which is at the next higher low. There was a couple of really good examples. I think it might have been Stellar, which did exactly that recently. Now, this is for me, and you can choose to do whatever you want and operate however you want. When market conditions change, I may change these rules. So my next rule is I'm going to plan my trade and trade my plan. Trade what you see, not what you think. This comes back to the trading psychology a little bit, and I'll just touch on this quickly. With the previous organization, the July newsletter, which came out as everything went a little bit haywire and crazy, and a lot of people probably missed that newsletter, which is really unfortunate because I think I wrote about a 5-page article on trader psychology, and it's probably one of the best things I've ever written in my life. I'll put my hand on my heart now and tell you guys that 80% of what you do in trading is to do with market psychology and your mindset. The other 20% is your technical analysis skills and everything else. But I can tell you right now, 80% of your success will come from your mindset and how you perceive the market. So on that topic, I'm still diverting from my rules here. I'm very sorry for that. I can't reproduce that article because of copyright laws, but I will do a video which will outline all the pertinent points in that article. In the meantime, what you guys can do, and I highly, highly recommend you do this, is either read the book by Mark Douglas called Trading in the Zone, or jump on YouTube and do a search for Mark Douglas. There are a number of half-hour to 1 hour long interviews, which are a great view. Or if you really want to be serious, and again, I highly suggest you do this, there are a number of workshops on there. And these are 5 and 6 hour long YouTube videos, which you can take your time to go through. But they are workshops which go through his books and his philosophies. And well worth it, guys. Really worth it. Okay, enough about that, and I apologize. So back to my rules. Again, trade what you see, not what you think. Focus on consistency and flawless trade execution. not profits. They will come when you do the other, okay? Remember to think in probabilities. Everything we do in trading is about probabilities and risk to reward ratios. It is as simple as that. If in doubt, sit out. So if I have any conflicting variables, or I'm unsure of something, or I start to think and not trade mechanically, I sit out. I don't take the trade. If I'm sick or I'm overly tired or feeling off, I do not trade. As Mark Douglas says, you want to be trading in the zone. You want to be at peak concentration, feeling good, feeling positive, and not making trading errors. Patience, patience, and more patience is my next rule. Do not chase the market. The market will come to you, and there will always be more trades. So the next one is to look for reasons not to take a trade. Okay, in the current market conditions, I'm being very conservative. I'm taking only the trades that look like the probabilities are in my favor, and there will always be more trades. So if there's conflicting variables or something that doesn't add up, right now I'm not taking the trade. And never, ever, ever trade without a stop loss, ever. I think I'll do a brief blog or a video on this one as well. This is probably one of my lessons learnt. Initially investing or trying to invest in this space and suffering some significant losses. Okay, as I've learnt and as Mitch preaches, this is definitely a trader's market. You should not be investing in ideas, dreams, and aspirations of some team of guys that have put together a LinkedIn profile that everyone thinks are going to change the world. When these projects start making money, when these projects start demonstrating their successes and being showing some clarity in their earnings, and there is, I guess, to some extent, some regulation about what they have to provide to the market for investors to assess and get into these things, that's when you're going to see the real projects leap forward. That's when you'll start finding the Googles and the Facebooks, okay, guys? Right now, not you, but people are putting their money in to whichever coin token really has the biggest dreams and aspirations, or more specifically, the best marketing team. Okay, I'll leave that there and let you think about that some more, but feel free to ever touch base with myself or Mitch on this, okay? That's one of my lessons learned. Okay, guys, lastly, I have my mindset or psychology rules derived from the Mark Douglas work in his book. Now, this starts off by saying, I am a consistent winner because I objectively identify my edges. I predefine the risk of every trade. I completely accept the risk of every trade. I act on my edges without reservation or hesitation. I pay myself as the market makes money available to me, i.e. scaling out, and not letting a winning trade turn to a losing trade. I continually monitor my susceptibility for making errors, and I understand the absolute necessity of these principles of consistent success, and therefore I never violate them. Now, this list here, as well as my trading plan, I'm going to put on my wall in front of my workstation at home to be read every day. Okay, guys, now lastly, just to wrap up, feel free to do your own research and develop a trading plan that is right for you. This was mine, and right now this suits my situation. I am a full-time employee. I work full-time, so trading is not full-time for me yet. Therefore, my rules are derived around what availability I have to review the market, and I guess my risk and profile at the moment in the current market conditions. One thing I probably did leave out of my strategy or mechanics section is when I do sit down and scan the markets, and I probably didn't put that in because timing is different for everyone around the world, but I will typically look at the markets and do a full scan half hour or so before the daily close. For me, that is 10 a.m. in the morning. And I will probably do at least another full scan on a 4-hourly close, probably for me around the 6 p.m. mark. Now, from those scans, I will create a watch list for the day, and I'll check that watch list at other closing times, 4-hour closing times. So you could probably add that to your trading plan. I didn't feel it was necessary just because of time zone differences. Now, I've provided a Word version of my plan with this video, which you can all download and use as a template. But feel free to ask any questions, ask for any recommendations, and I'll do my best to help everyone out. That's what I'm here for. Lastly, if you ever want to show any appreciation for these video blogs and you do find that you are really getting some information from them, or simply from my interactions and help along the way, feel free to contact me on Discord for a Bitcoin address or some other means to tip or show your appreciation. However, honestly, a simple thank you or a bit of kind feedback will certainly be thanks enough. Thank you very much. Talk to you in the next video, guys. Take care.